Hey guys, Tiny Bryson here, and today we're about to break down the difference between an index fund, an ETF, and also a mutual fund, and which one is better, which one do I invest into, and what the heck is up with all of these, okay? In this video, I'm going to break every single one of them down. And by the way, at the end of the day, all they really are just financial instruments, but some of them cost you a ton of money, and some of them don't. So in this video, I'm going to tell you what I invest into and which one I also recommend, along with what each of them also mean. And by the way, I post videos on this channel every single day. So make sure to also subscribe to the channel and hit the bell so you're notified every time I post a new video. And on top of that, also destroy the like button. And now guys, without further ado, number one is an index fund. Tommy, what exactly is an index fund and how do I invest into one? Well, the first thing is this, guys, okay? An index fund is just a type of mutual fund, or for example, also a type of ETF. But don't worry, I'm also going to break those down later on in the video. ETFs, mutual fund will be broken down right here. I'm going to cover everything, don't worry. But whenever you think about, for example, an index fund, just think about something, an index of something that's trying to track or replicate the performance of something out there. So for example, guys, some index funds track the top 500 companies in the stock market, and that's when you hear, oh, the index fund of the S&P 500, that is what it is, okay? On top of that, another index fund might be like, hey, I want an index to track the overall performance of basically the entire real estate market, or for example, the whole tech industry in the stock market. So basically what you do is you build an index fund made out of all of those stocks, and that way you get to track the overall performance. Then the way I think about index funds is basically something that tracks the performance of something else, and that is the entire idea. So in reality, you can't really buy an index, because in reality it's just like something that tracks something, but you can buy an index fund made out of investments trying to track something else. Hopefully that makes sense, and that's how I think about it so I don't get confused. But if you don't understand it, comment down below, let me know, and that way I'll reply and kind of explain things even further. Now, number two, Tommy, what exactly is a mutual fund and how exactly do they work? How do I invest into them? And also, how much does it actually cost to invest into a mutual fund? Well, the first thing is this, guys, okay? Whenever you think about a mutual fund, just think about, for example, if you want to go out there and start a fund. So for example, here's an interesting way to actually look at it. Say, for example, you want to be the manager of a whole bunch of assets out there. So you want to start your own financial institution, your very own mutual fund. So in reality, you're going to be the manager of all the money that people come in and invest into your institution, your mutual fund. So in reality, a mutual fund is just a fund by a manager, also employees, and then outside people invest into it in hopes to get some profit. And that's the whole thing, okay, to be honest. But that's not all, because you also have, for example, actively held mutual funds and also passively held mutual funds. And the entire idea is that, for example, actively held mutual funds basically tell you, manager A tells you, hey, I have a mutual fund, I actively hold it, I trade back and forth, and I'm trying to beat the stock market every single year and its performance. And because of that, I'm going to charge you between 1 to 2%, but hopefully we're going to beat the stock market every single year. Again, that is manager one, and that is called an actively held mutual fund. However, you also have manager B, and that basically is for a passively held mutual fund. For example, like the Vanguard ones out there. And the idea is that these managers basically say like, hey, I am not going to really trade. All I'm going to do is manage the money that comes in and that goes out, and basically also pay you the money when you actually trying to get paid. But I'm not going to trade, because again, I'm going to let the index fund do what it does and basically just try to track the market. That way is not as expensive for you, and I'm only going to charge you 0.20% every single year. Now you might say, Tommy, well, 2% or 0.2% doesn't really seem like a big difference. But in reality, when you are investing for like 10, 20, 30, 40 years, that amount of money can quickly add up, especially since the average return of the stock market is only around like 7% every single year. So say, for example, let me grab some fake money here. Say, for example, say for example, yes, this is prop money, okay? I don't keep this much money in my house, it's ridiculous. But say for example, you have $10,000 and you want to invest it into manager A and also manager B. So let me grab some more. So say for example, again, you have $20,000. You're gonna put $10,000 into manager A's hand and also $10,000 into manager B's hands. And the idea is, well, one is gonna try to beat the market and the other one is going to try to basically just track the market. But this one's gonna charge me 1 to 2% every single year, and this one is only gonna track me or cost me every single year around 0.20%. Now you're probably wondering, tell me, what is going to happen to my money in 40 years at a 7% interest rate? And the answer is surprising, okay guys? Because here's the math here, okay? In about 40 years, manager A at 2% is going to cost you around $79,344.69 just in fees, not including the taxes. However, again, 2%. But this one right here at 0.20% is only going to cost you around $10,797. So that is the big difference. And also, it's not a small one either. It's like a $69,000 difference. If you ask me like, hey, I want all of my money and I don't want to spend any money on any fees, especially giving you money trying to beat the market, because in reality, guys, just to be honest here, I was being very nice because basically the data shows that the average mutual fund does not beat the stock market over a long period of time. And the best strategy is just to basically track the market and not try to beat it. So in reality, you're not going to get like 7%. Some years you might get a lot, some years you might get much less, but over time, this tracking the market is going to end up a lot better. But don't forget, guys, okay, some cons are basically, hey, whenever these funds are trading back and forth and all that fancy stuff, they're also inquiring taxes and you also have to pay those. But again, another con of mutual funds is basically, well, a mutual fund, remember, it is not in the exchange, not in the stock market. So again, when you go to one of these funds, you have to buy yourself inside of them. Some of them might be $500, some might be $10,000, some might be $20,000, and some might be even more than that. But the idea is most of them have an admission fee, and it might be high sometimes, and they also might be low. But again, the fees of 1% or 2% are very high if you're going to invest for the long term. And on top of that, again, because it's not in the stock market and there's not a lot of demand for these, in reality, whenever you're trying to sell, well, you might have a hard time actually trying to sell. Oh, and by the way, one more interesting thing about mutual funds is that basically whenever you're buying a mutual fund, the price per share of that mutual fund in reality is not actually clocked in every single second, every single hour, every single 2 hours, every single minute. In reality, no. You only really get a price at 4 p.m. every single day, and that's when you actually try to sell, and then you might have a hard time selling depending on how much you have, but it all depends on the demand for that actual fund. And by the way, guys, if you're wondering, tell me, well, in reality, in your example, how much money would I actually have if I just put $10,000 and forget about it for like 40 years at a 7% interest rate? Well, in reality, you would have around $149,000 minus the fees. And in reality, that 2% is going to cost you almost half of your money. And that is the big problem, because in reality, guys, remember, if you're getting 7%, well, 7%, okay, 7% minus 2%, 5%, minus maybe like 1% or 2% for taxes, you're only left with around 3% for yourself. And that is the big problem with paying manager A so much money to try to beat the market, when in reality, history shows that he's not going to do it. He's just going to take your money and basically use it as a big salary, but not actually going to perform whatsoever. So the best thing is join a mutual fund that is holding your investments passively and is not costing you a ton of money every single year. That is the idea. But overall, again, a mutual fund is just a fund with other investors' money, and that's about it. It's very simple. Now, the last one is number 3. And it's kind of like the new kid on the block, and that is called ETFs. And ETFs stand for Exchange Traded Funds. And the idea is, just like mutual funds, but unlike mutual funds, they're actually traded in the stock market, in the exchange. That's why they call exchange traded funds. And the idea is that, well, you know, whenever you're actually buying a mutual fund, you're basically buying it based on the overlying assets. But whenever you're buying, for example, an ETF, you're buying it also based on the market demand for that product right there. And I actually like that a ton. And here's why, because basically I could buy, for example, the S&P 500 ETF, and basically invest into it at a discount because the market says like, hey, it's actually not that high right now, but it still might be high. That's the point. So I like being able to basically go ahead and invest money at a discount by buying ETFs also. And on top of that, with ETFs, you have a lot more liquidity, meaning that whenever you want to buy or, for example, sell, you can actually sell it a lot faster because, again, it is in the exchange. And by the way, you can sell it at a profit very quickly because guess what? The price fluctuates a lot. And that's something that I actually like because basically I buy for the long term, but if I want to sell, I can sell very fast, very quickly at a profit. And on top of that, from a tax standpoint, you also save money on tax because you only get taxed when you actually sell and not when the fund does anything with the money underlying it, okay? That is the overall idea. So overall, guys, for this video right here, whenever it comes to index funds, it's basically just tracking something. And mutual funds are basically just funds with managers, actively and passive ones, to basically create funds, for example, index funds or whatever they want to do to basically track the overall market, or for example, the tech market, the real estate market. It all depends, okay? And by the way, whenever it comes to an ETF, remember, it's traded in the stock market. So in reality, if you're using an app, for example, like ACORN or SOFI Money or Robinhood, that lets you buy partial shares or fractional shares, in reality, you can invest not with 10K, but with $1, $10, $5. And if you ask me, the best app right now to use, for example, to buy ETFs is probably ACORN. I use it every single month, and also SoFi Money and also Robinhood. That way you can invest with like $1 or $10. And I'll put a link down below. When you sign up for Robinhood, you get one stock. And when you sign up for SoFi Money, you get like $25 to $75. And when you sign up for ACORN, you get like $5. So overall, this video is just free money, if you ask me. But overall, guys, seriously, I hope this video helps because basically at one point I was also confused. And the way I think about it is basically, hey, index funds kind of track something. Mutual funds are either passively or actively, so one costs me money, one doesn't, because it's trying to do all this stuff to actually like try to beat the market, but in reality, he won't be able to. And also, ETFs are traded on the stock market. And overall, again, these are all securities, okay? It's all like investments. So in reality, what you want to do is pick a route and just get started investing. I don't recommend like actively held funds. It costs way too much money over time, guys. Not worth it. Just get one that's like maybe 0.5%. Any more than that is like crazy. It's an expense ratio. It's like costs too much, to be honest with you. So overall, if you ask me, Tommy, where do I go? I would either go, for example, into ACORNs, Robinhood, or if you just want to invest and have somebody actually do it for you and actually guide you through everything, just go to Vanguard.com and call one of the advisors and they'll help you a ton. And they're also very, very cheap. And I actually love Vanguard a ton, okay? So Vanguard is a great resource to go out there, either learn about investing or basically invest with them, and also save a lot of money on taxes, and also save a lot of money on actually paying someone a lot of money to basically do the wrong work for you. Again, guys, I hope this video helped. And on top of that, as always, comment down below any questions. And on top of that, if you enjoyed this video right here, guys, and it was helpful, well, like this video. On top of that, also subscribe to the channel and hit the bell so you're notified every time I post a new video. Also follow me on Instagram at Tommy Bryson. And I have a second channel called Tommy Bryson Show. I post there every single day. Also, link down below. Check it out. It's hilarious. And I'll see you guys next time. But before I go, if you want to watch another video on the basics of investing, well, here it is right here. I'll see you guys tomorrow. Thanks for watching. And as always, peace.